Well, let's kick off the show today by discussing the state of the British economy. Because yesterday, the Bank of England raised interest rates for the fifth time in a row, up to 1.25%, the highest since the financial crisis, but still historically low. The bank's Monetary Policy Committee announced that the decision was a bid to temper rising inflation without choking off economic growth. Well, joining me now to talk through how well they did and what effect it may have is Dr. Andrew Lilico, the Executive Director and Principal of Europe Economics. So welcome to the programme, Andrew. I suppose 1.25%, it doesn't sound like a lot, but it did rise by 25% in effect. What's the effect of this?
Well, the effect will be to slightly increase mortgage rates for those eventually as it flows through. I mean, the vast majority of people have fixed rate mortgages just at the moment. In fact, the considerable majority, almost the entirety of mortgages that have been new over the past few years have been on fixed rates. So it won't affect them immediately. But over time, as people refinance their mortgages, those have become more expensive. It'll make borrowing a little bit more expensive. It might affect the monetary growth in the economy. So all of these things will tend to bear down a little bit on inflation. However, inflation is scheduled to go to 11%. That's the Bank of England's latest estimate. So the difference between what the interest rate is, 1.25%, and what inflation is scheduled to be as 11% is at a many decades high. That gap is enormously negative and has never been as negative as that since the early 1970s.
Should the bank have raised rates higher still then?
Absolutely. It should have raised rates some time ago, and it should have raised rates more on this occasion. The Federal Reserve in America raised rates by 0.75%, not 0.25%. 3 members of the Bank of England's Monetary Policy Committee voted to raise rates by 0.5%. I would have thought that was the absolute minimum. I would have thought you'd have probably wanted to raise by more than that. But the Bank of England is well behind the curve here. Now, part of the reason for that is that over the past couple of decades, chancellors have consistently encouraged the Bank of England to see through what they regarded as temporary spikes in inflation instead of keeping inflation under control in individual years. Now, this is all very well if inflation is going to be, 3.2% instead of 3% in a particular year. But if inflation is going to 11%, it's not very cheerful for the rest of us to say, oh, well, sometime in a couple of years, inflation will eventually come back down to 2% by itself. Well, yes, but in the meantime, we have to bear all the consequences for our cost of living of very rapid rises in prices.